No, my name is Rachel Bromlow. I'm National Account Manager at TSB Mortgage Intermediaries. It's a different topic today. So today we'll be looking at current trends in the mortgage market, credit behaviours and how to manage decline conversations. If you do have any questions as we go along, just use the raise hand button and I'll answer them there and then, but I'll make sure there's some time at the end for some questions. And you might remember from last time we did a little quiz, we did have a winner who did get a prize. So hopefully we'll have time for another little quiz just to sort of test your learning from the session. So we'll start with an economic update, but as you'll all be aware, it's ever-changing volatile market. So I have had to already update that this morning, even though I updated it yesterday. And then we'll have a look at some mortgage trends so far for this year. And then another hot topic at the moment, all around credit behaviour and how you can support your clients who are either starting their mortgage journey, getting to review their current options, or just making sure that they're in the ultimate position when they come to apply for a mortgage, really. And then we'll have a look at how TSB criteria can support your applications with some criteria highlights and some TSB overviews, because you might have seen in the press there's been a few changes with TSB recently, so I will talk to you about that as well. And I'll just take the opportunity to just remind you that we do have a TSB Mortgage Intermediaries LinkedIn page, so it's worth following that just to keep up to date with things that are going on. And also it's currently live at the moment, the FT Advisory Awards, the 5-star service. So you'll get one opportunity to vote. You can vote for whichever lenders you want to vote for. We do only get that one chance to vote. So if you do vote, please bear TSB in mind and give us a vote as well. So let's crack on. So you might recognise this snapshot. So this is available on our TSB intermediary site and it's pulled together. Is somebody asking a question there? Did somebody say has the talk changed? Yeah, we're looking at credit profiles and we will be going through credit profiles. I think someone's just asked a question on that. I'm just going to do a little market roundup first. So, but yeah, you might recognise this. It's on the intermediary site. It's our chief economist, David Fenton, who pulls this together and it gives you a brief snapshot of some of your favourite topics. So interest rates, outlook for bank rates, housing and jobs, etc. And you can actually share that with your clients. It does tend to go down quite well with the TSB logo being on there, and it's a recognised high street bank. So the market does remain resilient but financially tighter, and early year optimism faded in March as we saw the mortgage rates rise again. But transactions have held up better than expected due to buyers acting early. We're no longer in a boom and bust market, but just one that's adjusting quickly to shocks rather than stalling completely. And during the week that started with the May bank holiday, the residential mortgage market experienced an expected decrease and the total value of applications dropped by 21% to 5.4 billion, while the number of applications were down 19% to 22,309. Buy-to-let applications also slowed during the May bank holiday weekend, with both application volume, value declining, and the applications actually fell by 30%. So the market, based on the week previous, so not last week, the week before, it's actually decreased 22%, but we're seeing a little bit more activity again this week, but we are still in a very volatile market. And as we know, statements from Donald Trump can impact everything. And we've got more local political issues as well, with the pressure on Keir Starmer to resign. So let's have a quick look at some highlights from last week's market activities before I move on and show you a couple of slides with the swap. So we've got the Makerfield vote where Andy Burnham is looking to get re-elected, and then maybe we will see a leadership contest. Andy Burnham's now 81% chance of winning the Makerfield by-election. That's by betting markets after a strong question time, if anybody watched that. He did also confirm over the weekend that he would challenge Starmer if he has the support to do so. But the thing that kind of impacts us really in our markets is that there has been reports that Burnham has asked for advice from Lord Jim O'Neill on how he can boost infrastructure spending without breaking fiscal rules, which would likely result in increased borrowing. I did have some statements and things from Bank of England, but I'm conscious that you might not want all of this market information. I don't know if you want to put in the chat whether you want the market slides or not. But from the Bank of England, we did hear from Andrew Bailey, who said the energy price shock from the Iran conflict is not quite as severe as in 2022. And the MPC have time because financial conditions are tighter, but caution that the MPC can't wait for hard data on second round effects before acting. And then I've just got a few different opinions from different people. So Megan Green is a little bit more hawkish. She's saying that the lack of resolution on the conflict strengthens the argument for hiking rates, believing tightening of monetary policy over the next few weeks or months might be necessary. So we've got a few things to look out for. So I will just show you these a couple of slides to go through here, which is the swap rates. So they did close last week 8 bips higher relative to last Friday's close. So 2-year was at 4.23 and 5-year was at 4.25. And what these charts here just show us is really how volatile the market is at the moment. If you don't use anything to currently track the swap rates, there's an app called investing.com, which is a really good app and allows you to predict the lender's moves depending on how the swaps change. But it is an investing site, so they do add on a little bit margin. But what it allows you to do is just see the trends over the last. You can look back a week, you can look back a month, a year, whatever you're wanting to do. But it's quite interesting to see how different statements or different things in the markets are impacting the swaps. So that was investing.com. 2 more charts for you here. So your first chart shows your likelihood of any rate cuts or hikes with the implied overnight rate and the number of rate cuts hikes between now and April 2027. And also this has come back into the news after the weekend and the conflict in the Middle East seems to be kicking off again. But this is showing you the cost of crude oil, which is currently trading at $94 a barrel. So pricing of rate hikes remains around 45 bips for the year, but it has changed over the weekend and the markets are now pricing in a 1 bip of a hike in the next Bank of England meeting, which is in June. So pricing in 49 bips of hikes in 2026. So to summarise, if we got a potential circuit breaker, a key uncertainty for the Bank of England is whether the 2026 energy price shock will lead to a second round effects on inflation in 2027 and beyond, as companies and workers strive to protect profit margins and spending power. The latest labour market release was on the soft side of expectations, which might act as a potential circuit breaker. But there's 4 developments that I would potentially flag. So unemployment increased to 5%, number of payrolled employees fell, vacancies fell, and regular pay in the private sector decelerated. So on their own, none of those movements are especially eye-catching, apart from the payrolled employees. And even then, the ONS noted that the earlier months in the tax year typically carry a greater degree of uncertainty in their initial estimates and tend to receive larger than average upward revisions. But collectively, the fact that these developments point in the same dovish direction will make it easier for the Bank of England to hold rates while further information follows. So we shall wait and see. So let's have a look at the trends and predictions that we've seen in the market for this year. And after that, I've just told you there, it's safe to say what started as a year looking at like 2 base rate reductions priced in, and now I'm getting the market pricing increases from mid-year onwards. It is a volatile market for 2026. And actually the top 6 lenders have taken around 60% of the market so far this year. And that's according to data that we receive from 27 Tech on ESIS production. So it's important to call out that's just on your quoting, not on applications or completions, but they're definitely taking the lion's share of the lending so far this year. And what else have we seen? Mortgage rates and borrower behaviour. Average mortgage rates rose sharply in March from 4.2% to 4.9%, reversing any gains that were made earlier in the year. And remortgage is the main driver of activity. Most borrowers are locking in deals early, well ahead of product expiry to manage volatility. And nearly all remortgages in March, 98%, secured rates above 4%, just highlighting the importance of forward planning and early advice. First-time buyers, so they do remain active, particularly in London, where they now account for around half of all purchases due to reduced investor competition. And over half of first-time buyers are using 30 years or longer mortgage terms to manage affordability. A key advice point around long-term costs versus short-term payment relief. And in Q1, residential mortgage market activity experienced a sharp decrease towards the end of Q1, in large part due to the fact of the Easter Monday bank holiday, with the total value of applications declining by 22%. Net borrowing of mortgage debt climbed to 6.2 billion in March, up from the 5.2 billion seen in February. And gross lending was found to have increased to 28.7 billion from 24 billion over the same period. So looking ahead, net mortgage approvals, which exclude cancellations, and they're seen as an indicator of future borrowing, rose to 63,500 in March, up from 62,700 in February, while remortgage approvals, not including your PTs, sustained with the same lender, increased at a sharper rate, climbing from 41,200 to 51,300. So you may have heard me say this before, but the UK Finance are predicting the overall gross lending will rise by 4% this year to 300 billion, and a 10% rise in external remortgages, with 2% rise in product transfers. So it makes it a great year for keeping in touch with your customers and making sure you've got a good contact strategy, which will come on to my next slide, to make sure that they're set up ready to go with the lender of their choice. And a further 1.8 million fixed rate mortgages are due to come to an end this year. So it's a big maturity year. So we've got a mix of higher rates ending and some 5-year deals, which will be coming off lower rates onto higher ones. And either way, a client will need advice in the current volatile market. They can't just rely on ChatGPT. So we've got lenders improving affordability options, plenty of cashback options, making it easier for customers to move to a new lender. And again, the next few slides that we go through will just make sure that they're in the right position to be able to go to the lender of choice. And PT market is doing really well as well. So in 2025, TSB saw 7% more customers choosing to stay with us and do product transfer for the mortgage lender. In TSB as well, our direct teams have seen an increase in further advanced business so far this year, which should show us some green shoots that consumers are now happy to increase their borrowing for various different reasons, home improvements and Debtcon being the biggest. Some other little bits of trends. So our latest quarterly mortgage report reflects that 91% of first-time buyers have been able to negotiate an average of 22,900 off asking prices across the UK. And average deposit amounts have changed as well, dropping from 23% to 18%, taking the UK average down to 40,000, with regions like East Anglia and the West Mid seeing even steeper falls. And the average first-time buyer age has remained at 31, but in London it's climbed to 34, making it the oldest region for new buyers, whereas we're seeing younger buyers in the North East, West Mids, Yorkshire and the Humber and Wales, and they're around 30 years old. Which sort of adds up, given that we're seeing borrowers using more than a fifth of their gross pay on mortgage repayments. And then I've put a little quote in there. So Atom Bank came out with a statement that lenders need to be more flexible with imperfect credit scores. So hopefully our next slides will help with your credit conversations. But before we do go on to the next slide, you'll see some handy tools reference at the bottom. So you've got some newsletters that you can subscribe to, UK Finance Mortgage Solutions, that will keep you up to date with market changes as they happen. And then the reason I put gov.uk on there is because actually we've seen an increase in fraudulent applications. And last year, TSB, as I mentioned on my previous session, we stopped 731 cases from proceeding, preventing £174 million of potential losses for TSB. So using things like gov.uk will just help you to verify customers' details like company accounts, etc. And then I've got the LinkedIn logo on there, which is a great tool for you to connect with your customers, keep up to date with lenders. And then David Fenton, our chief economist, also sometimes does some updates on there too. And then your last one you can see in the corner here, so check my file. Hopefully you all use some sort of credit reports with your customers, but check my file is really useful to support your decline conversations and also when keying your cases. So over the next couple of slides, you'll sort of see why I've referenced that one as well. So if we know that overall lending is likely to increase in 2026, then it's really important that we can guide clients to be in the best financial shape when it's time to discuss their mortgage. And this year, our intermediary teams have had a closer look into credit scoring and how we can educate clients to understand credit behaviours, because we've seen an increase of queries around credit blips. So whilst we're all working financial services, the average home buyer might not fully understand what impact their credit choices have when they come to apply for a mortgage. And what we discuss now help you handle decline conversations. The client will understand why a lender might have said no, and it's a sensitive subject, so handling decline conversations should be treated with care. And some customers will also think that because one lender's declined, then all lenders will decline, but we all know that lenders will all have a different risk appetite. And what we'll go through now, reduce how many decline conversations that you might have to have, as well as being able to explain why a lender might have declined an application. So we can educate more customers, and it also makes your job easier, because I'm sure you'll have had those cases that just cause you a headache. So the first thing to point out is that a lot of lenders now work with a highly automated operating model for credit scoring, which helps cases to be accepted and turned around quicker. But using this method means that there's not always as much manual underwriting, and the lenders will see a black and white story about the customer and make a decision based on that. So with that in mind, let's have a look at some of the behaviours from clients which can support them to get the best deal, and also what you can do when you're keying cases that'll enhance your experience with not only TSB, but with all lenders, and help you get the credit decision that you want. Something that comes out quite a lot in these sessions is that the customers think that they've got an Experian rating of 999, so it should be fine. I should be passing with every lender, but actually it doesn't mean they're going to pass a lender's internal score, because the credit score you get from places like TransUnion and Experian, they also include available credit and affordability. So what it can do is actually make the credit score look better than what it actually is. So it's all going to start before you even dip a case with a lender. And the tools we discussed before, so the Check My File, will help you guide your conversation, which is why it's really important to have your good contact strategy that I mentioned, and understand your client's financial position from the outset. And Check My File definitely help with that. So it gives you the 4 credit reference agencies, 2 of which TSB will use, which are TransUnion and Experian. So let's have a look at keying the case. So it's really important, and this, you've probably been doing the job a while and it sounds basic information, but it's really important that all cases are keyed correctly. But you would be surprised how many times we see cases that have got basic keyed under bonus, which is automatically going to decline on affordability because there's no basic keyed. But thinking about using TSB system, which is the MSO system, make sure you key the basic under basic, and any additional income is keyed in the appropriate boxes. So for example, shift allowance or overtime, don't clump it all up into your basic, and that'll be the same for other users of MSO. And something to really take time to consider is the makeup of the customer's income. And it's actually best practice to key all of the income, because that'll support lenders' policies on things like debt to income. We regularly see cases that have declined where they're not using all the income, because it will trigger that debt to income code. It can make a difference from an internal scorecard decline to a pass. So I've delivered sessions to our direct advisors as well, so you'll know they've only got TSB to choose from. So if it's a no, they're going to have to let that business walk out the door. So they have had cases where they've only keyed in the basic income, but actually the customer's got some bonus in the background. The case declined just on the basic, but actually when they keyed in this extra £400 that they got once a quarter, the income was then auto-verified and the case then was accepted. And the same goes for things like commitments, so keying a student loan under interest-free loan, that could change the decision with a lender. So it does need to be keyed under the right part. And actually on Check My File, you can see the description of the credit commitment as well. So matching that will just save you time and having to rekey the cases. If it's not keyed correctly the first time, then you're going to have to key it again to make sure you're getting the right decision. Things like time and employment as well can impact a lot of automated scoring systems. So while most lenders are taking income 3 months in advance, it can impact the scoring. So definitely find out if your client's got any plans for any future changes, because you need to take that into consideration as well for your timing. Other things like open credit cards. So if your customer's got 5 different credit cards, they don't use those credit cards, they've got 5-10 grand credit card limits across all of them. It's really good for you to be reaching out to the customer nice and early, because if they are in that situation, that could impact the automated scoring system, because they've got all that available credit that they could just go down to the local shopping centre and use all that available credit at once. So that is going to impact internal credit scoring. We've also had cases where brokers keyed in the car insurance as a commitment. We don't need that to be done. It triggered a C11 decline code, but once it had been changed, then the application actually passed. Another example of this is using keying a credit commitment, such as a credit card, as a credit card instead of a loan. So you do need to make sure that you're keying the commitments as they are. So what can the client think about before they come in to change the mortgage or take out a new one? So cash flow, we've got overdrafts. Do they need to use the overdraft? Is it just a convenience? Some lenders don't like the excessive overdraft usage. So encourage your client to try and reduce it, a bit like a credit card. So reduce the limit every month as to what they can afford, because we all know that if you've used an overdraft, that's now your normal zero balance. And then obviously you've got your implications of exceeding the overdraft limit, which can be costly and impact the scoring. So we can see from the credit profile what the credit card balance is, but it's really important to remind customers that things like cash advances have a real impact. So on an automated scoring system, that could look like the customers experiencing cash flow issues, and they're having to get access to cash really quickly, and it's usually at a higher cost. And this regularly comes up when someone's trying to do some home improvements. So maybe they're coming up to the time where you might contact them because they're coming up for renewal, and you might be looking to remortgage to a new lender, but they think, well, I can't wait another month, so I'm just going to use my credit card, get some cash withdrawals, but actually that'll then have an impact on their applications. So utilising credit card limits. Again, when doing home improvements, we see that quite a lot, where customers will just go out and think, well, I'm going to remortgage next month, so but I want to get this done now, so I'll just use my credit card, and then use it quite a few months quite quickly and soon get up to the credit card limit. That quickly looks like, again, that they've got a cash flow issue. So just reminding you that when you've got these automated credit systems, we're taking a black and white view on it rather than painting the full picture. Another thing to think about is your first time buyers. So they always want to build the credit, don't they? Because that's another common thing, is a thin credit profile. But what we often see them do is take a credit card which is advertised as a credit builder. They take a small limit, let's say £500. They quickly utilise that full limit, and then they start to make minimum payments. So again, that can look like a cash flow issue, because on decline cases, one of the main reasons is because they're paying the minimum payment. So it doesn't look like they can afford to repay that debt. So always paying over the minimum payment helps. When actually in that first time buyer scenario, it's best for them to have a credit card, maybe pay for their fuel, and then pay it off in full that month, which demonstrates a completely different behaviour, as opposed to fully utilised and then paying the minimum payment every month. So you'll see on that little box that I've turned over there, Klarna, and you're probably all thinking that causes you a lot of issues. It is a common issue we see, and we have seen a rise in this type of borrowing. And you'd be surprised how many people don't know it'll re-credit score every time you use it. And it's a behaviour just to remind people about, because if they've already got a thin credit profile and start to use Klarna, that can then look like a cash flow issue. We've had cases accepted where they've got 20 pages of Klarna, but they've already got other credit commitments that are managed really well. So it doesn't mean because they're using Klarna it's going to decline, but it's thinking about what an automated system would look like. And most of these people who are using Klarna, they tend to have the cash in their account. They just want the convenience of interest-free credit. So credit profiles, I mentioned earlier, Experian and TransUnion scores also factor in the affordability and the available credit. So even if someone has a high Experian credit score, it doesn't mean that a lender is going to accept the mortgage application. Thin credit profiles can be an issue with first-time buyers, but also with remortgages with additional borrowing. So some things that can really help here are being on the electoral roll, keying the addresses of the customers, not moving around too much before they're about to apply for a mortgage, and then your credit cards. So pay them in full, don't just pay the minimum payment, or pay more than the minimum payment will give you a better picture. So thinking about mortgage terms, so one of TSB's USPs is that we'll allow a remo with additional borrowing for debt con up to 85% LTV and will ignore the debts being repaid for affordability. But it's important to remember that these kind of cases, so remo with capital raising, do come with more risk. So you need the customer's credit health to be in the best condition possible before you apply for these, because remo with additional for debt con has the lowest acceptance rate for lenders. And terms also play a factor in that. So you'll often see the applicants extending the term to accommodate for the additional borrowing. So if you're discussing budget, then utilise the full budget rather than going to the max age for the customer. And that includes going past retirement ages as well, so maximising the LTV. So a remo with additional for debt con at 85% with some debts in the background is going to be a lot more risky for a lender than a remo with additional 80% with all debts cleared. All of these things are going to prolong the lending and increase the risk for a lender, and it'll have a negative impact on that automated scoring system. So these are all just additional behaviours to think about. We've got the obvious factors like missed credit card payments, but if we can educate customers, we can hopefully have a better chance of securing a best deal for a client and not letting credit get in the way. So I've also put on here the link to our adverse policy on the TSB intermediary site and guides of how to key commitments. So we've got PDF forms of how to key things to make sure that your applications are right first time. But hopefully that'll give you an idea of the conversations that you can start to have with your customers early and get them in the best financial health before applying for the mortgage. And then that should result in less decline conversations. But then when you do have to have that decline conversation, you can use this information to help to guide the customer as to why it might have declined, because there's nothing worse than just going to the customer, oh, it's not past the lender's internal credit scoring. It looks so much better to go back, well, tell me about what activities on your credit card. Have you had any cash withdrawals? Do you know why that might have impacted you? So it definitely sits better to have that kind of decline conversation, and they're going to be more understanding as to why it might not have passed. Is there any questions on any of that slide just before I move on to the next one? Kind of that was quite a lot of information about internal credit scores. I think the key point to remember on your internal scores is we are getting a black and white picture. There's not somebody sat there underwriting the whole case, which is why all these behaviours really help to get your cases over the line. Questions? I'll move on. So I thought I'd just go through a little bit of TSB bits, probably take us about 10 minutes, and then we'll go into a little quiz just to see what you've learned from the session. But before we do start on this, I just thought I'd give you an update on the recent Santander acquisition of TSB. So ownership from TSB has now changed from the 1st of May 2026 from Banco de Sabadell to Santander. So what's going to change? And the answer to that for now is simply nothing. Customers won't be impacted and will continue to transact with TSB just as before change of ownership. And as for the future of TSB, we don't know the answer to that yet. And we're likely to see no impact for the remainder of 2026. So it is business as normal here at TSB. Anything that you see that's not official from TSB or Santander is just media speculation. I know there was a couple of weeks ago, there was some articles in different news outlets, but that's just another reason to follow the intermediary page, because you'll get the official updates from there. So why can you trust TSB? So we did send out a broker trust survey recently where 93% of brokers said they would trust TSB with their business and 99% were satisfied with their BDM. And just to let you know, we do have a team of over 20 field-based BDMs, and we also have a team of telephone and video BDMs. We've recently launched our live chat on the website, which is run by the TBDM team and not bots, so you will get answers that make sense. And we've got regional case management teams for you to speak to about the processing of cases, as well as specialists for self-employed and new build cases as well. And for new build applications, we also have a service guarantee. So if you've uploaded all your documents onto the case, we'll guarantee to work that within 48 hours. And our field-based BDMs, they don't have targets. They pride themselves on service. So answering phones where possible to provide the support there and then, or they will return your call within 3 working hours. So there's plenty of support for you when you come to looking at TSB. And like I mentioned before, we also use the MSO system, which makes the application process a lot smoother and you can get real-time updates. So we've talked a lot about credit. So we do a soft credit search at DIP, and we offer free basic valuations on all resi. That includes a change of property. So that's something we've seen a lot and over the first half of this year, is properties falling through, change falling through. Actually, if your customer's in that scenario, as long as they've found a new property, as long as they're in the same LTV, they can keep the same rate as well, and we won't charge them a valuation fee. And 60% of our valuations are either done digitally or via desktop, which just make your applications quicker as well. There's loads of cashback on offer, so £300 cashback or free legals on your remortgages, and on purchases we've got £500 cashback for LTVs over 85%, with additional £250 available for A and B rated properties. And that's all paid on completion of the mortgage, so you don't need to wait for the first payment to go out or all those different rules that some lenders have. And something else that will continue to be essential is the offer validity period. So again, seeing customers with all the rate changes that went on in March, people are doing things a little bit earlier. So you'll get your 6 months offer on offer, and you'll get another 28-day offer extension if it's needed. And then if it's a new build, you can also apply for another 6 months on top of this. So I'll do you a little whistle-stop tour and some criteria changes that we've already done so far, and there are some more things planned for the next few months, so just keep an eye out for those. So we removed the minimum income requirement for buy-to-let applications and changed the stress rates as well to make them more favourable. And we improved the maximum loan to income for self-employed up to 5.5 times income. And July last year, residential stress rates, we reduced those and made that a little bit easier as well, because we've given you the option for the 2-year and the 5-year, which you can see on the calculator. I mentioned the energy efficiency cashback as well. So that came in last September. And one of the big ones for us this year has been universal credit, using that as other income as standard. It used to all go to underwriting, but now there is a calculator for you to use on the intermediary site, and that'll tell you exactly what amount of that universal credit we would use. You can then put that on your DIP, and then we'll just review the case as normal. And while we mentioned PTs before, we've done some criteria changes this year already, but the thing that's landed the most is a new tool that's available for you, which is the account lookup tool on the website. So you'll have your M number from your original TSB application. Your customer's looking to do a product transfer. You now need your mortgage account number, which you've not got. So you can just pop that in the tool, and it will give you the account number. We've also changed the LTV for foreign nationals, so that's increased, and we've also launched portfolio buy-to-lets as well. So that's a maximum of 10 mortgage properties, with 5 being able to stay with TSB. So a few changes that I've already done, and we will have some more coming up. So we'll go on to our next slide. Hopefully you can see that. Looks like it's duplicated one of the slides, but this is just a great chance for me to share with you why other brokers have been using TSB, where it's not just been rate driven. So I mentioned before about new jobs. The good thing for us is we don't need to wait for that first pay slip. We can just use the contract and covering letter. So they might have even moved in and completed on the mortgage before they've got that first pay slip. Latest year's bonus is accepted. So if you've got a customer who's got an annual bonus this year, they didn't even work for the company last year, that's fine with us. We're just interested in the latest pay slip. Doesn't get averaged out over 2 years. second job. So people who've got more than one job will use 100% of the income. It just needs to be sustainable. So you can't have somebody working every single day of the week. You need to have some sort of rest day. Pension and other payslip deductions are ignored for affordability. Then we've got commission and overtime. If you've just got 3 months payslips and they've only got it on one of those payslips, even if it's not the latest, we would just average that over the 3 months. Or you could use an employer's reference to verify what they've received so far over a year to get you a little bit more on affordability. This has been really popular as well, so non-simultaneous let to buy with no onward resi is accepted. Large loans, so depending on where you are in the country, any loan over 500,000 with TSB is different underwriting, but anything over 750, you can pick up the phone to our senior underwriters and put the case to them before you even do your DIP, and they will consider net profit for your self-employed applicants as well. Already talked through this one is the 85% LTV for remortgage with capital raising. We're not going to ask you for the evidence of the home improvements. If they want 10k for home improvements, we're not going to ask you for all the quotations for that. And if you're doing some sort of debt comp, we'll ignore the debts that are being cleared pre or on completion. Another one that's been popular with properties falling through, chains falling through, is 95% LTV and an onward resi. So if they've got a property in the background, they're getting a new resi, you can still go up to 95%. Section 106, we see a lot of those as well, and shared ownership we offer too. And if you've seen your TSB BDM recently, they'll show you the affordability demonstration where we have got built into the stress testing any debts that are remaining, it might be ignored as well for affordability, which is why we get quite a lot of business on shared ownership. So I'll just open it up to questions. We're at 22, so we should have time for our quiz. Anybody got any questions on anything before I move on? Nope. Okie doke. So let me get this quiz ready. So if you've got your mobile phone with you, that is the easiest way for you to get into this. So I'll just get the code. Okay, let me just try and share my screen again now. Does everyone know how to use a QR scanner? If you can see the QR, you can just scan that, or you can go on Kahoot and sign into a quiz. And your game pin is 2788233. And there will be a prize sent out to the winner. So I think we've got about 7 people on there, but 16 in the call. So I'll give it 30 more seconds. The code again, if you need it, is 2788233. Okay, so let's get started. Okay, so you need to get these questions right, and the quickest person gets more points, and the winner will be sent over a prize. So, UK Finance are predicting that overall gross lending will increase by what percent in 2026? So it's 4%. And then we've got a true or false. So this is all around credit behaviours. So if a customer has lots of credit cards with nil balances, this could impact their overall score with a lender. So is that true or false? Yeah, it is true. So get them to close down those credit cards. A client's experience score is always reflective of their current position. Some quick answers coming in there. Everyone? Yeah, it's false because we mentioned before about including available affordability and also yeah, their affordability and available credit. So this one's a multi-select, so you can select all that apply. Which credit agencies the TSB use for mortgage applications? So we use Experian and TransUnion, so that's what you're checking on Check My Phone. And again, we've got a multi-select, so select all that applies. If your client is looking to build their credit, what would you advise them to do? Just to confirm the second one, so undertake a cash withdrawal, it's confirming that if oh, you've all answered. Perfect. And then we've got a true or false. So TSB will offer a free valuation on a purchase, but the client will have to pay if there's any change of property. Is that true or false? No, it's false. You need to pay for the valuation if there's a change of property. Another true or false, TSB ignore debts being paid for affordability when the client is repaying them on the application type. So this has got to be repaid pre or on affordability. We've got another multi-select. When using annual bonus for income on a TSB application, which of the following are true? So 100%, we'll use 60% for affordability and we will just use the latest annual bonus. So another true and false, so we've got this one and one more and then we're all wrapped up. TSB will use new income 3 months in advance, even if it's the applicant's first ever job. So is that true or false? It's true. So you've never shown university, never got any job experience or anything before, that's absolutely fine with us. And then this is a chance for you to just pop in any thoughts or comments. So what's been your one takeaway from our session today? So it could be about credit scoring, it could be about the TSB bits of criteria, it could be the changes in TSB, whatever your thoughts are, just pop them down. Give you a little bit longer for this one. We've only got 10 seconds left, so if you can try and get something typed. Just ping up. So it should give us. So we've got in third, Lucy Elrich. In second, SD. And in first, we have who'll be the winner of our prize, Brendan. So hopefully you found that little bit of a roundup of what we've talked about today. But if you do have any questions, just reach out to me or to your BDM, whether that's a video BDM or a field-based BDM. I'll send out the certificates to anyone who's popped it in the chat. And if you need anything else, just let me know and I'll hand back over to Mohan to wrap it up for you.
Thanks, Rachel. Really appreciate that. That was really good. And thank you for that. And we'll definitely be sharing that with all the advisors. So thank you for your quiz as well.
Yeah, no worries. I'm just checking I'll be able to see the chat once I've left to make sure everyone gets what they need.
Yeah, I was going to say, anybody that wants CPD certificates, please can you put your email address in the chat? And will you be able to send those out directly, Rachel?
Yeah, I'll send them out directly. If I can't see the chat once I've left, I'll just give you a shout if you can just copy paste it over to me. But thanks for participating in the quiz, and I'm glad to see everyone's taken at least one thing away. And I'll speak to you soon.
Right. Thanks, Rachel. Cheers.
Thank you. Bye-bye.
Bye-bye. Bye-bye.